Hey, folks, here we are. I know there are people that will sign in along the way, but I wanted to start this seminar at 7 o'clock. And it's really going to be brief tonight. We're not going to be a long-winded night, but I want to cover some very basics, the why, the how, the what of the infinite banking concept and the understanding of banking and how that we manage our money every day to the best ability that we have. I personally believe that everyone in America that earns at least above poverty level income should end up at retirement with $1.5 million, a minimum value at retirement time. And it really all comes down to the 6 inches between our ears. And in Nelson's book, in the introduction, and you see it behind me back here, but there's Nelson's book. And in the opening of the book, the introduction, and it just says, becoming your own banker, the infinite banking concept is a text for a 10-hour course of instruction about the power of dividend paying whole life insurance. It is not a sales tool for life insurance agents. It is an education that the life insurance industry should have taught during the last 200 years in America. And when I look at this and everything going on, we want to make sure that we really focus on what we're talking about. And this banking concept, I met Nelson Nash in the year 2000. And initially when I met Nelson, I got his book, and that first edition of his book was green and tan. And in that process, the green and tan looked like a military manual of some kind. And I put it on the shelf, and I never really opened it, never read the book, just put it on the shelf like so many other things that I have and accumulate books on the shelves. A few years after that, I happened to be the president of a General Agents and Managers Association. And Nelson was invited to come and speak. Well, I was the president of the organization. So that made me the MC. And so I had to sit there in front of Nelson the whole day. And they held me down and poured in the Kool-Aid. And there it was. I finally got the message. And it was a journey. It has been a journey over the years. I brought Nelson into Pittsburgh probably 5 or 6 times to do his 10-hour training session that this book encompasses. And starting this out tonight is the first, it's probably going to be maybe 10 hours total, but I want to do these seminars for not only my associates that are here, and I see Karen, hi, how you doing? But also for clients. I want this to be an educational process so that people that have embarked on the banking concept, they get an understanding of, what it means. What do I need to do? How do I do this? Now, as we do this, I will tell you now, all these are going to be recorded, and there will be everybody that signs on will receive a link to the special Dropbox that I'm going to establish, that each one of these recordings will go into this Dropbox. And you will have access to this recording at any future date that you want to access it, to listen to it over again, etc. And I don't want it to turn into just a lot of talk and just me. But basically, when we talk about what Nelson said in this very first paragraph, and it's really the power of dividend paying whole life insurance. And I just want to expound on that a little bit. And I don't think people realize today there are about 800 or so life insurance companies that sell some kind of life insurance in the US retail market space to consumers. In the year 1980, in research, in 1980, there were about 2,000 life insurance companies operating in America. But in the early 80s, you had the turmoil of the 80s, the high interest rates, consolidations, mutual companies demutualized, and on and on and on. But in 1980, out of the 2,000 companies, about 70% of all the assets of the insurance industry were held by about 120 mutual life insurance companies out of the 2,000 in 1980. Today, there's about 800 to 850 or so companies that sell life insurance. And in my mind, there are basically maybe a dozen to 20 companies that I would truly consider a dividend paying mutual life insurance company that operates with a fiduciary responsibility to provide the maximum benefits and the maximum money supply to the policyholders that own the company. See, all the other companies are corporations owned by stockholders, and therefore the profits of those insurance companies are fed off to the stockholders, not policyholders. And in that process, isn't it interesting that universal life insurance is the key product in all of those stock insurance companies that are owned by stockholders? Most of the mutual life insurance companies today, the dozen to 2 dozen that I recognize, focus on dividend paying whole life insurance today. And the design of that product in a way that it combines a whole life insurance based policy and what we refer to as a paid up additions rider. And just some history of that, I remember 47 years ago when I went to work for a major mutual insurance company at that time that has since, during the 90s, demutualized. But I always wondered in my mind that this wonderful magic whole life policy with dividends. Now, you have to realize back in the 80s, when the interest rates ballooned after Jimmy Carter to 21.5% prime interest rate of the government, the dividends skyrocketed. So they were amazing. So in an insurance policy at that time, a dividend paying mutual policy, within 5, 6, 7 years, it would have enough dividends in it that would be premium offset. And they referred to it as vanished premium back then. When the interest rates started to subside toward the end of 80s and the early 90s, and things started to normalize, the dividends went back down. And those people that were promised a vanishing premium, the premium didn't vanish. So it led to class action lawsuits across the industry in doing that. So I talk about some of this because I believe there is history required to know where some of this thinking came from that Nelson used to develop and write his books, The Infinite Banking Concept. So out of that, universal life insurance with high interest rates looked so good, everybody thought it was going to be the destruction of whole life insurance and the guarantees that were involved in the dividend paying whole life policies with mutual insurance companies. And when the interest rates fell in the early 90s under Greenspan down to 2-3%, the rate of return wasn't there. And those universal life policies that agents had projected 15, 20, 30 years into the future that were going to pay and earn 12% interest, 10%, 14% interest, it didn't materialize. So the cost of insurance ate up the cash value in those policies. And those folks, a lot of good people lost their life insurance, and a few of them, their health had changed. So they lost their life insurance at a time when they weren't physically fit enough. They didn't have enough good health to buy more insurance in a favorable way. So it hurt a lot of people with what went on. So today, with our approach with the banking concept and the dividend paying mutual life insurance companies, I just want you to be aware that the average person on the street, the average consumer, is not going to find this out. This information is not broadly available in the marketplace. You will only find this information if you seek out through the infinitebanking.org, their organization, and look for a licensed certified practitioner, of which I am a certified practitioner of the infinite banking concept. In fact, I have a couple of new potential clients right now that found me through that database at infinitebanking.org and so forth. So they have a lot of free information, a lot of videos, and a lot of education that is available for people that really want to learn this. And I know that has been my challenge in working with new people in changing the whole paradigm of thinking. You know, when I work with folks and I try to explain to them, you know, here is the financial world that we are all accustomed to. We have all been brainwashed by. Our parents were brainwashed by. And the financial world has basically 4 rules. I want all your money. I want more ongoing. I want to keep it forever. And I want to give back as little as possible. Their success and their maximum profit potential comes from being in control of your money in perpetuity. Now, what do you mean, Tom, in perpetuity? How do they do that? Well, an example, the majority of retirement savings for working folks ends up in 401ks. Agreed? So your 401k does what for you? Okay, well, out of sight, out of mind, it helps with the discipline of savings. They take it out of my paycheck, so therefore I don't spend it. That's a discipline problem. Number 2 is they feed you the line, oh, you're going to be in a lower tax bracket when you retire. That is a story that's been going on for 40 years since IRAs were created, that originally were sold by insurance companies that originally could be life insurance policies, which were high cash value policies by design. And then the law changed and you couldn't buy those policies anymore that were IRAs. But everybody was told, oh, you're going to be in a lower tax bracket when you retire. And glory be, the only way you're going to be in a lower tax bracket when you retire is if you're broke. So number 1, the first fallacy is, here today, you're a young family and you're raising kids. And you know what? You don't really have a tax problem today because you have a mortgage and you have children and you have all these deductions today. So you're putting money into these tax deferred plans while you're in a low tax bracket. When you get to retirement, if you have done well and you have accumulated and saved a lot of money, you are not going to be in a lower tax bracket. Your kids are raised, so the deductions are gone. Your mortgage is probably paid or pretty much paid for. So the deductions are now gone. And who knows what the deductions are going to be in the future compared to what they are today. So it's important to realize that a 401k and an IRA is a pig in the poke. And a lot of people see that after you have a discussion. So you've taken money, you've thrown it as far as you can into the future, and you've postponed paying the tax. That's all you did was postpone paying the tax. Now, if you're getting a match, I understand. So, but I would not put any more money in beyond the match. However, when I say this, it has to be the thing in my mind that even though I'm not putting in a 401k, I still have to save the money somewhere else. And that is the problem that I have found, even by my own experience, that people need help with the discipline of savings. And then as time goes on, they have to be educated in, well, what can I do with the savings after I start to save it? So the 4 rules of the financial world, I want all your money, more ongoing, keep forever, give back as little as possible. I turned those around in my book, The Family Money Farm, and my new ebook, Financial Mastery Coaching and the Blueprint. So now the 4 rules over here on your side of the table is the goal is to save 20% of my annual income. Accumulate accessible capital equal to 50% of my household income, and get out of consumer debt or own it myself, which means if I have to buy something that I can't pay for out of 30 days of income, that is the true definition of debt, by the way. I'm going to finance it myself, but I'm going to pay me interest on the money, on the debt. And that's another story. I'll get into why that's important to understand that. And then the 4th rule is the CFO Project. And the CFO Project is nothing more than you've now taken control of the family finances, which leads to multi-generational thinking. You know, a simple example of that is I have a 39-year-old daughter, a son-in-law of that age, two grandchildren, a 5 and an 8-year-old, and I own life insurance on both my daughter and my son-in-law. And my goal is to live long enough to educate my two grandsons so that at my demise and my wife are gone, that the ownership of those policies would go to my grandchildren. Now, in the meantime, while things are going on and premiums are being paid and all of that, guess what? We use the cash value to finance automobiles or large purchases that have to be made, et cetera. My daughter just paid her car off to my wife and I, and my son-in-law is on the verge of paying his pickup truck off and doing the same thing. But they are learning and understand the concept. So imagine when I meet people for the first time and I start talking about family, you know, I would ask them, is your mother and father still alive? And a lot of times, well, yeah. And then I would say, are you expecting a large tax-free inheritance when they pass away? And most people have a negative no answer. And then I say, well, why? Why don't you? Why aren't you expecting that? Why didn't you take advantage of the opportunity and plan for that? And the reality of that is there's an old saying that I grasped, is you can't take it with you. You know, there's a story that I tell people that, you know, this very, very wealthy man, all of his life said he was taking it with him. Whatever he had, when he died and passed away, he was taking it with him. Well, all of a sudden we're at the funeral and he had one daughter, and the daughter was sitting there. Everybody was moving around and starting to leave, and she was doing something over by the casket that hadn't been closed yet. And the minister that was there, he looked at it and he walked over and said, Sally, what are you doing? And she looked at the minister and said very simply, look, my father said he wanted to take it all with him, so I'm writing him out a check and putting it in the casket, and so he can take it with him. Now, that's a funny story, I believe, but it's the reality of it is. But every time somebody passes away, they do take it with them. They take their economic human life value with them. And that is where the problem comes into play. As we sit here and look at the government and the $31 trillion of debt and $171 trillion of unfunded liability, the government, as we know it today, is broke. This is never going to get fixed. It's never going to go away. And somewhere in the future, this bullet train is going to crash because the bridge is out somewhere in the future. I'm not predicting when that's going to happen, whether it's going to be in my lifetime or my kid's lifetime. I just want to make sure that with all of that bad stuff going on, I need to make sure that I create the most value that I can create for those grandsons looking at the future. So how do I do that? Well, that comes down to my Cfo Project concept, and that's simply being efficient. So we need to work maximum efficiency today. And how do we do that? The number one most expensive thing that we all do and causes us to lose money unknowingly and unnecessarily is the banking equation in our life. You know, this banking equation that Nelson always talked about is out there. And no matter what we do, if we play the game with their rules, we lose in some way. And all that being said, if I put on my financial planning hat, I have all these initials after my name, so I've taken all the courses. And what that really tells me is if I were sitting here and you're 40 years old and your wife and your kids are teenagers and you were now starting to think about retirement planning, well, how much do you need? When are you going to need it? What interest rate do you have to earn on the money between now and then? You getting the idea? Because all of those things are assumptions. And assumptions, in my word, make an ass out of you and me. You know, the word assume, excuse my French, but that's the reality of what it is. But now we look forward and say, okay, well, how much do I need when I get there? I need the most I can get when I get there. That leads me to what I learned from Robert Kiyosaki in his books, Rich Dad, Poor Dad, and the Cash Flow Quadrant. Now, he has written a dozen other books. They're all great books. I've read most of them. But the key information, the key education that I got was out of his book, Cash Flow Quadrant. And that Cash Flow Quadrant book talks about money in motion. That leads me to what Nelson was talking about, money in motion. And he uses an example of water. And I'm going to jump through, I'm going to share my screen, and I'm going to go through a few of Nelson's slides. I have his program. We're not going to go through all of it, but I want to go through the first 4 or 5 slides to get an idea, because it all starts with the thinking. The 6 inches between our ears is where it all starts at. So I'm going to share my screen. There it is. And you see my lovely wife. Now I'm going to make this screen bigger. Bear with me. And we're going to turn the show on. And there's the show. So now you're looking at my screen. And Will Rogers, a great American philosopher, the problem in America isn't so much what people don't know. The problem is what people think they know that just ain't so. So it really becomes an issue. The human animal is a learning animal. We like to learn. We are good at it. We don't need to be shown how or made to do it. What kills the processes are the people inferring that it or trying to regulate it or control it. The truth indeed is something that mankind, for some mysterious reason, instinctively dislikes. Every man who tries to tell it is unpopular, even when by the sheer strength of his case he prevails, he is put down as a scoundrel. So truth is really about what's going on. So without big banks, socialism would be impossible. Vladimir Lenin. So now we look at that and say, okay, what's next? And now we talk about, this is where Nelson talked about water. You know, we drink water, we pee it out, it gets evaporated, it goes into the air, it turns into ice in the North Pole, the South Pole in wintertime in some parts of the world, but it is still the same water. You know, it rained here the other day. The water that came down from the clouds in rain, where did that vapor, that water vapor originate at? It could have originated all the way around the world in Australia on the other side of the world. But if you and I don't consume water, because our body is what, 80% liquid, 80% water, if we don't consume water, we die. And the same thing applies to what Nelson talks about when he talks about infinite banking concept. Becoming your own banker, the infinite banking concept. And this screen is very simply an exercise in imagination, reason, logic, and prophecy. So an exercise in imagination, what do I mean by imagination? And that's nothing more than you're only limited by the 6 inches between your ears. So people that walk around with blinders on, and I know all about life insurance, I know all about this, and I know all about that, are going to be lost because they are going to be left behind with what's going on. And Nelson taught me very early on that imagination is what this is really all about. And that was helped with a guy named Bob Castellone and the League system and the PS&G model that I can actually illustrate movements of money. So velocity of money and multiplier, where did that come? That is an imagination. It is also based on reasoning, and it is also based on logic. Now, what do I mean by the logic? In other words, I have an econometric model that is run by mathematics that I can now prove mathematically what entry point on this 3 components with 9 elements in each component, I can actually mathematically prove the best carburetor. In other words, where is the entry point to put in the money? And that's what the model did for me. And I still use that model, but it has expanded in my thinking and concepts to helping people understand. Velocity of money and multiplier on one aspect, on the financial world side, would mean fractional banking in the financial world. And if you don't understand what fractional banking is, I explain it very simply. You put $1 in the bank's going to pay you a 1% interest today on that bank account. They're going to take that dollar and they're going to loan it out to somebody else in a mortgage. So the mortgage is going to be 5% interest the bank's going to earn. They're going to pay you 1%. So they made 4% after they paid you 1%. So they paid you 1% means they made 400% profit. Now, every time you go to the bank and borrow money, you can only borrow money if you have collateral. And collateral is nothing more than this asset that you put up as collateral, whether in a mortgage, it would be the property. So it's your house. However, the bank's name is now on the deed and they have a lien against your property. They actually own it. Their name is on the deed as a lien holder. They take that deed, they go to the Federal Reserve window, and at about 1/4% interest, they leverage that asset that belongs to the bank now, and they acquire approximately 95% of that value, and they loan that 95% of that value out a second time. So now they loaned it out to another couple for another mortgage, a home equity loan, or in some other way. But every time they loan it out, they receive some kind of collateral. Whether it's an automobile or whatever it is, there is some kind of collateral involved. If it's not, then it's a credit card. And now we're talking about an average of 18% interest on a credit card. So if the credit card with no collateral, you're going to pay the bank 18 to 28%. And I have met people pay, they were late on one payment. So immediately the credit card pumped the interest rate up to 24 or 27.9% on that credit card. So that gives the bank high interest rates quick. Fractional banking does the same thing because on average, the bank can loan out $1 on average 7 times. So if they make 4% on each transaction, average. Now, the second transaction, do you get any of that profit of the banks? No, you don't. They get it all. So they're going to make 20 to 28% on that 7 turns of the money. Now, you and I cannot do that. We cannot print money from nothing the way the Federal Reserve does. So now we have to look at things differently. And differently means velocity of money and multiplier to you and I means as $1 flows through my life, remember, money has to stay in motion to create more money. And I'm going to use those dollars, and I hope to get 2, 3, and 4 turns on that dollar. Now, we've been on here for 30 minutes now, and I want to keep these under an hour, but I want to just give you an example as I close up today on where we're at. So now I put $1, let's say I put $10,000 into my life insurance policy as a premium, whatever death benefit it buys, but it is by design a policy that has maximum cash value early that the law would allow, because there is a tax law, Rule 7702 of the Internal Revenue Code, where you will find a definition and an explanation of what life insurance is. You see, it's important to keep a policy within the scope of the tax law because of the tax benefits and the tax treatment of a respected, recognized life insurance policy. You have tax deferred growth. You have tax-free access to that money. And ultimately, the death benefit is paid, and it is also tax-free. There is no 1099s created, blah, blah, blah. So it puts you in complete control of your money. Now, in this 3-component model that I use, the life insurance is in the protection component. There is a savings component, and that's where the cash value would show up. So I put $10,000 into this policy, and it creates a death benefit. There are other benefits involved there at the same time, but I'm not going to go into those today. But my focus is on the cash value. So in the first year, when I put in $10,000, it's going to create maybe about $6,000 of cash value. I'm going to put in the second year, and it's going to create another $4,000 to $7,000 of cash value. So now I've got somewhere around $12,000 to $15,000 of cash value. And the third year is the secret year. Anybody that understands anything about business, if you are starting out a brand new business, cold, out the door, brand new business, the IRS doesn't even question you not making any money for at least 5 years before they have an expectation of you making money. So now the third year is the key year, because most of these policies, if you're 40 years old, 35, 45, most of these policies are going to show a positive cash value increase somewhere between the third and the fourth year. Now, I put in $10,000, my cash value increases by $10,000. I am now going to borrow $10,000 out of that policy as a loan because I just purchased a duplex. The monthly mortgage payment on the duplex is $833 a month. That's easy. That's $10,000 a year, folks. $833 a month times 12 is $10,000 a year. So I bought this duplex, and I'm gonna go to the bank and I'm gonna say, Mr. Banker, look, I can pay you monthly or I can pay you annually in advance. If I give you the annual payments all at once in advance, will you give me some discount? Oh, so now we're in the negotiations to get some discount. So now I paid the mortgage, which does what? Well, I have rents. So now the rented dollars, the rent money comes back, and it is now used to start repaying the loan. And if I got the mortgage payment in a year, the rent should be more than my annual mortgage payment. So it's going to be that same dollar going into the life insurance, going into the cash value, coming out and buying and paying the mortgage payment on this duplex. That now creates new tax benefits against my income because I have depreciation, and now I have rents that are coming out from this rental property and going back into the policy. Well, if the rents are equal to the $10,000, can I not go now and search out and find a second duplex and buy another real estate investment? Oh, so now I have the same $10,000 I'm putting annually into this policy. But now look how much more additional wealth I have created just in that capacity. Now, there was a lot of other things that can be done with this along the way, because that one policy isn't going to be the last policy I buy. I have 10 or 12 policies on my wife and I, my daughter, my son-in-law, the grandkid. I have policies on everybody. They're all banking type policies with cash value. And they fund all of the things that go on in our lives. And guess what? Even if I borrow a lot of money, the death benefit's going to replace the money. So it gives me a really valuable way to do things. Now, let's talk a little bit further. I have a disability benefit on my policy that if I become disabled and I can't perform the regular duties of my regular occupation, I'm going to be deemed disabled. So that means the insurance company is now going to put in the $10,000 a year tax-free. Does that really stop me from buying more real estate and keeping the money in motion and doing what I'm doing? No, it doesn't. So that disability waiver is what it is referred to, is a very, very unique benefit. Policies that are issued today also have an accelerated death benefit provision where, God forbid, you're terminally ill with cancer or some other disease and documented you have less than 12 months to live. You can access up to 50% of that death benefit, up to a $250,000 policy before you die. There was also an extended illness rider that is like, we can't call it long-term care insurance, but it gives you access. If you can't perform 2 of the 6 activities of daily living which are the requirements to collect on a long-term care insurance policy, now you would have access to the death benefit again, 24% of the death benefit, up to $1 million total face amount policy. So I guess that would be like $240,000 a year that you could access again, tax-free, to cover stay-at-home, nursing home. There's no restrictions on how you spend the money. The only thing is you have to not be able to do 2 of the 6 activities of daily living. And what's that? Dressing yourself, feeding yourself, medicating, toileting, blah, blah, blah. So there are 6 of them that are recognized. So this concept is really encompassing, because that brings me back, and let me wrap it up today, is this retirement concept, because I don't care whether you're 30, 40, 50, everybody in the back of their mind has this idea. Someday I really want to stop working, and we refer to that as retirement. I don't like the word retire because it means I get tired all over again. That's just my perception of it and what I'm doing. But I want to develop this passive residual income. See, typical planning looks and says, okay, here's my goal. How much money I have to have when I get to retirement. Well, what interest do I have to make on the money between now and then? How much do I have to save between now and then? How much will I need when I get there? I don't know the answer to those questions. But I do know that if I focus today on maximum efficiency of my money and stop losing money unknowingly and unnecessarily, and start building passive residual income. So now I make an investment, whether it's a real estate and I have rental income coming in, or I have an investment that generates dividends and capital gains, could be my life insurance generating dividends paid to me annually, whatever. But I now have income coming to me. I'm going to use that income to start paying some of my routine ongoing expenses, my auto insurance, my homeowner's premium, my medical insurance, and on and on and on. So when I have passive residual income coming in, paying those expenses, that means I don't have to pay for them out of my working income. So I can now take that money and purchase more investments that generate more income, that pay more of my expenses, that frees up more of my working income to buy more investments. So ultimately, there will become a day in the future where my passive residual income is equal to or greater than my monthly lifestyle requirements. My friends, that is, in my mind, the only true definition of retirement, where I have passive residual income already in place, equal to or greater than my lifestyle expenses. Anything other than that is a crapshoot on what's going to happen into the future. You know, when I look at this stuff going on and everything we're talking about, and prophecy, you know, Nelson was a very, very Christian man, and there is so much of this that is God's plan for everything that we do. I spend every day of my life polishing people's eyeglasses so they can truly see the potential in their future and the opportunity that lays in front of them. It is so, so important. I spend every day of my life helping people change their thinking, change the way they think, and help them find a way that will get them to what most people really, really want. With that, the plan is to be back here in 2 weeks for session number 2, and we will continue the story of Nelson's infinite banking. And hopefully I will continue to lay the groundwork and the reasons why. It's really about the why do I want to do this? That's an important thing. And I would challenge you to go to usdebtclock.org and study that page. That's a page created by the Congressional Budget Office of the federal government. Those are the CPAs of the government. They are not political in any way, but it shows all of the money movements of the federal government. And you will be sick to your stomach when you see the numbers that our current politicians have left us with. The only thing political that I will add to these talks is you need to vote in November. We need to impose term limits on all of these old politicians that don't put America first. We need to vote them out. They're not going to vote their own term limits in Washington. They're not going to eliminate their own jobs. So you and I, as citizens of America, voters in America, we need to vote this November, November 22. God bless you all, and I will see you here in approximately 2 weeks. You'll get emails, let you know when the next session is going to be, and I will get this put into a Dropbox. I'll get the Dropbox set up. Give me a couple of days, and I see those that were here tonight, and I will send an email to everybody and give everybody access to this in the Dropbox. Now, those of you that are advisors and associates, feel free to use this with clients, because this whole series is designed for consumers, for people to learn and understand this concept. God bless. Bye-bye.